So I will have to be brief. What I want to put to you today is very much an experiment, a monetary experiment. By experiment, I mean the following. This is not a scientific experiment, but the closest to it in social sciences. I don't know if you know the name of the chair of the Federal Reserve Bank in the US, effectively the central bank in the US, Jerome Powell. He went to Congress a couple of times, well, several times in 2020 and 2021, and he was asked by the Congress people there whether the policy they were running at the time was going to be inflationary or not. And he responded, and I quote, "The relation between money and inflation ended 40 years ago," end of quote. If he is consistent, if one is consistent with this statement, then does it matter whether the amount of money in the economy grows by 5%, 20, 50, 100%? And that's precisely the experiment that I'm going to put to you, that I put to myself, and I did it with my colleague Tim Congdon when we assessed the conditions of the economy back in 2020. So indeed, truly a monetary experiment. Just to give you a bit of context, here you have the rate of inflation in the UK over the last 200 years. That's the discontinued line. And then the solid black line is the CPI, the Consumer Price Index, since the early 19th century and onwards. So as you can tell, the economic history of the 20th century is the history of inflation. Inflation was not a phenomenon. It was not an issue back in the 19th century. So that's the context. And then, of course, in war times, it is expected for the government to use, as they say, the printing press in order to pay for the war efforts. That's understandable. There's a big crisis in the country, and you use as many resources as possible to defend your country. And that's what happened during World War I and II. What is not natural is what happened afterwards. It's the continuation in this inflationary drift after the war, after the Second War. And indeed, an acceleration in this rate of inflation in the 1970s. So what we have been doing over the last 40 years is to try to resume, to go back to some form of a monetary anchor, some monetary stability, some price stability that we managed to do with the application of inflation targeting rules very successfully in this country since the early 90s, since the crisis of the ERM system. The Bank of England has been pursuing an inflation targeting strategy, putting a limit to the rate of growth of CPI prices on a yearly basis. And as you can tell, that experiment has been very successful. The rate of inflation decelerated and stayed around 2% on target for many years, with the exception, of course, of the COVID-19 years. As you can tell, the slope in the acceleration of inflation went back up again. So what's the problem? In my opinion, the problem you have here in front of you. This is the rate of growth of money broadly defined in the US over the last 20 years or so. By broad money, I mean cash in circulation created by the Federal Reserve System, plus the vast majority of bank deposits in the commercial banking sector in the US. So there was a period of stability of money growing at around 5% between 2012 and 2019. But beside that time, there was very much volatility. In the years before the outbreak of the global financial crisis, money grew up to 12%, then a deceleration in money growth, and then even a distraction of money. And something even more sharp, really. During the COVID-19 years, money grew up to 25% in the US, followed by a deceleration in money, and then even distraction in the amount of money. This is what I think that is bad for the economy. That's going to be my main policy claim, that we need to restore monetary stability if we want to go back to macroeconomic stability. So as Tim explained before, and we were working together on this at the time in 2020, we were observing back in the winter and the spring of 2020, we were very alarmed by the figures, the early figures produced by the Federal Reserve System on bank deposits. According to those figures, we could extrapolate how much money would grow at the end of the year. And these were our estimates published in 2020 in a paper published by the Institute of Economic Affairs with the data that we had at the time. That was actually data corresponding to April and May 2020. So again, it was early days and we could use the data that we had with us at the time. So with that data, we thought that the rate of growth of money in the US could grow up to 27%, from 22% to 27%. In the Eurozone, a bit less, between 7 and 12. In Japan, 4 to 7. In the UK, from 7 to 15%. And you may ask yourselves whether this is a high number or a low number. Well, let me go back to the previous diagram. Here, I drew the line for 5% rate of growth of money, which is basically the standard of the rate of growth of money compatible with a stable economy. By stable economy, I mean economy growing at 1.52% per annum, and the inflation rate at 2% roughly. So that's the amount of money you need to supply to the economy in order to maintain an economy growing at 2% and prices staying at 2%. So that's 5. Compare that benchmark to this. That means, in the case of the US, 5 times more than normal. In the case of the UK, 3 times more than normal. And in the Eurozone, roughly 2 to 3 times more than normal. So that was extraordinary. That was the experiment that we had in front of our eyes. The reason why we were alarmed is if you think that there is a connection between excessive money growth and inflation, that connection is delayed, but nevertheless a connection, then such a massive increase in the amount of money would inevitably lead to an increase in inflation later on. And yes, we were using a very common model called the quantitative theory of money in order to make these projections. One in which there is a connection between the left-hand side of the equation, M, and the right-hand side of the equation, P. How about the data? Well, here you have the actual amount of money, how much it grew in 5 economies back in 2020 and 2021. They were led by the US with a 25% increase in the amount of money, followed by the UK, 15%, and then the Eurozone, 12%. The other 2 economies at the bottom, they did increase the amount of money in Switzerland and in Japan, but not nearly as much, only a third of what they did in the US or in the UK, for example. So if you had, as we did, had the estimates and the data in front of us at the time in 2020, and you had to make a forecast, the question that you have to put to yourself is the following. This massive increase in the amount of money, this surge in money, in broad money, could only be neutral, could be non-inflationary, only if in your models you think that there is no connection between money and inflation, or you think that that tremendous increase in the amount of money is going to be absorbed by households and companies. So the amount of money is going to increase indefinitely. Those are the 2 assumptions that you can make in order to disregard this surge in the amount of money. And this is what happened with the actual data collected at the time. You have the left-hand side of the quantity theory of money equation. That's the growth in broad money. That's the orange line. That's the blue line is the growth in nominal GDP, which is real GDP plus prices, if you like. And then the green line is money velocity. Money velocity is the inverse of the demand for money. So what we did is to observe mathematically, statistically, how stable that series is. Well, as you can tell, before the 1950s, this refers to the US, by the way, is very unstable. It very much goes up and down all the time. After the 1950s, it's much more stable. And yet, you have periods of money velocity going up and then returning to the average. So it's very much a mean reverting series, according to the data available for the US. And you may wonder whether this is relevant or not. It is very relevant for policy purposes. Because if you are observing monetary data back in 2020 with such a fall in money velocity down to 30%, if you knew about this mean reverting property of the series, you could guess that money velocity is not going to stay there forever. It will rebound and go back to normal, as it did in the following quarters. And whenever that happened, the massive amount of money created by the Federal Reserve and other central banks would go somewhere that we will circulate in the economy and eventually would be inflationary. That's why that condition is so relevant. So here you have the result of this experiment, the same countries as before. At the top, the countries that expanded the amount of money the most, the US, the UK, and the Eurozone with very high rates of inflation. And how about the other two? They did experience more inflation, but not nearly as much as the other three countries. All these countries suffer from the consequences from the war in Ukraine, different degrees, but they all did, and supply chains disruptions, if you like, because of COVID. So those two conditions affected all these countries. And yet some of them suffer from more inflation than others. In my opinion, there are policy considerations here. Is the amount of money that grew much more in the first three countries as compared to the other two. So what's the policy conclusions? And I end with this. We need to go back to something that the former governor of the Bank of England said years ago in one of his books, is the what's going on here question. Just quoting Mervyn King, he was referring to the misuse of economic modeling in making monetary policy decisions. He said that models are neither right nor wrong. They are more or less useful. They are not descriptions of the world, which is why economic forecasts are often so poor. They can generate extremely valuable insights, but they are not a substitute for trying to figure out what is happening in the large world. John Kay and I recommend always asking the question, what's going on here? At first sight, this may seem trivial, but it is in fact immensely helpful in interpreting economic data. So if your models are telling you that the economy is not going to be inflationary, and yet you see that the amount of money and other indicators are growing far too much, 5 times more than normal, you need to ask that question, what's going on here? In my opinion, we should incorporate money, broad money, and monetary trends in our forecasting models of inflation. It would be effectively a way to make a monetary policy with money. So, as I said before, in my opinion, in this quest for a new anchor, new monetary anchor, in my opinion, preserving monetary stability can take us very far, really, in maintaining price stability over the medium term. Thank you.